There's two things that I'm really interested for the next, decade. Three things. One, try not to be too cute with markets, right? I mean, I don't know when gold prices are going to go down 5-10% and not just me, but anybody. I have a strong view that gold prices will be substantially higher. If that's the case, there's two trends that I'm very focused on. Mining, I think mining will do very well. You could see energy, you can see other things do very well, but I think mining is going to be one of the main ones. And number two is emerging markets. I think those are extremely mispriced today. Talk to me in 5 to 10 years. If I'm wrong on that, then I'm happy to admit and move forward. That's really where my allocation of time, capital, attention is really towards at this point.
While the price of gold is expected to continue rising for the rest of 2024 and into 2025, investors who want to add the precious metal to their portfolios still have opportunities. The keynote speakers at the Metals Investor Forum were in consensus on which gold stocks will move first, saying senior producers will begin to see more benefits while the price is strong. However, those willing to take on more risk may consider looking at gold stocks that have so far continued to lag. Portfolio manager at Crescat Capital, Tavi Costa, believes emerging markets are significantly undervalued and will be key drivers over the next 5 to 10 years. According to Tavi Costa, the surge in gold and copper prices during the 2000s was largely driven by China's growing influence. He points out that today's government spending is far greater than historical efforts, especially in construction and initiatives like the Inflation Reduction Act. Despite occasional divergences, Tavi highlights copper's strong link to economic growth and industrial demand, noting that copper and gold tend to move in sync over time. Gold outperformed during key periods like 2000 to 2003, 2018 to 2020, and 2023 to 2024, while copper led during rising yields in phases like 2003 to 2006 and 2020 to 2022. Each metal's strength alternated based on economic conditions and yield trends. Macro factors like inflation, interest rate changes, and monetary policy shifts heavily impact commodities like gold and copper. It is important to gain a nuanced understanding of the underlying dynamics. Renowned analysts, including Tavi, explain that the mining industry's leverage to metal prices can lead to big opportunities or challenges. He predicts that mining companies will benefit with gold prices rising next. Now we present the clips of Tavi Costa's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
What happened in 2000? Why did gold rise so much and copper also was rising as much as it did during that period? Some people will say it's because of China. China was driving both markets, really. What about today? What are we seeing? Have you seen how much spending we're seeing in construction? Or have you actually taken the Inflation Act and how much is being spent, even from the government, forget about private, and compare that with times like coming out of World War II, when we did, nowhere close to what we're seeing today. Even the Marshall Plan, which was a global plan, not in the US, was smaller than what we're seeing now, adjusted for inflation or relative to GDP, which is insane. And so the amount of money going into construction is also likely to drive copper prices. And I think that the whole idea of copper being more industrial and also having this connection with economy is true. It's very, very true. And potentially, this is the beginning of an era. Now, maybe this whole chart is wrong, and that divergence we're seeing is the beginning of a new era where copper goes one way and gold goes another way. That's not what I believe. This chart actually, if you go back to the 70s, was the same thing. And usually this is just the case because pension funds and other large capital allocators, gold has a potential to be signaling weakness ahead if it's rising. Not every time. Look at the early 2000s. When was that? That was the tech bust, right? And still copper did well. Look at that. Copper was still, going up. It actually had a little bit of a lag, which is the whole point of this chart, right?
Yeah.
It's the arrow that is a little bit ahead of it, but it went up. I think that the mining industry has a lot of leverage to metal prices. And leverage works both ways, in a good way and a negative way. If you catch the wrong wave of gold prices and metal prices in particular, you're done, right? It's going to be a very difficult period to be in the mining industry. if you catch the right wave where things are going up, and there's certainly a degree of that linked to gold prices too, but they do have leverage. And you start seeing institutional capital come in, scalability of projects. Things can change quite drastically. The whole reason of this chart is to kind of prove the point that, there has been fundamental improvement in this industry. And margins have been improving. It's needless to say that gold prices have been rising to the degree that we haven't seen in history. And other metals are yet to follow. So in my view, the next wave here is going to be very much driven by the mining industry. And so I'm very focused on this because gold prices have already showed the direction. And I think that the next one to also benefit from this is the mining industry. And, we're seeing general investors become more and more interested in the space. But the lack of knowledge and understanding of this whole industry, I think, reflects on the lack of efficiency that we have in how we price this securities. And, inefficiency is also a cool word for opportunity, in my opinion.
As inflation accelerates, Tavi Costa foresees the Federal Reserve cutting interest rates more aggressively than other central banks. He expects this to push commodities up and challenge the 10-year yield. Tavi also predicts a significant rise in the gold to S&P 500 ratio once the yield curve uninverts. There are several reasons that the post-election environment could continue to support the gold price, which has handily outperformed the S&P 500 index and NASDAQ 100 index through early September of this year. UBS analysts maintain a confident outlook for gold, stating that the rally in the precious metal is far from over. In a note dated Wednesday, UBS has raised its gold price forecasts, predicting that prices will approach $2,800 by the end of 2024 and climb to $3,000 by 2025. In a world of market fundamentals, Tavi asserts that gold stands out as the top asset, while treasuries excel in deflationary times.
Two reasons. One, as I said, I think the Fed is trapped and they're going to have to reduce rates more than other central banks, and they're going to have to act quickly despite what's happening. And that doesn't mean we're going to see 50 basis points tomorrow or anything like that. I'm also not saying this, but I think that the trend of rate cuts is here, and it's here to stay. And so, this is my view on the short end. So short end is likely to actually go lower. And then on the back of that, we're seeing inflation actually reaccelerating this, with the Fed acting that way, but also with more stimulus globally on the money supply front. We're seeing commodities starting to trend higher. If you are of that view that inflation is reaccelerating, you're probably of the view that the 10-year yield will be challenged. And the other thing that I think not enough people are covering, and they were covering a couple of years ago, and now this thing has been sort of on the sidelines, has been the issuances of treasuries more recently on the long end are starting to increase again. And I think that drives supply much higher, drives yields much higher as well. So I would not want to be long the 10-year treasuries or the 30-year treasuries. And I do think those yields are going a lot higher. And so if that's the case, you have a short end that is limited and is likely to go lower. The long end is got a lot of upside. So that means steepening is highly likely. Plus, historically, when you have a deeply inverted yield curve, what do you see on the back of that? Abrupt moments where the yield curve tends to uninvert and in a very significant way. And so I don't think this time is different. I think we're going to see that once again.
Historically, when the 10-year minus 2-year yield curve steepened in the past, which assets have historically done very well?
Oh, that's a good question. I actually did a full research on this, looking at, I created an indicator, and I actually did a presentation at the IMF about this, which is I was invited to because I created the percentage of yield curve inversions. So instead of looking at separate yield curve spreads, like the 2 versus 10s that you referred to and others, there are a lot of people tend to look at, I decided to actually create a little bit more comprehensive way of looking at this and looking at all possible spreads in the yield curve. There's about 45 possible spreads, and then calculating how many or how much percent of those yield spreads are actually negative. And when you go above the 70% handle, you tend to see a recession. And if it's not a recession, which actually happened, I think, one time, where equity markets, did well despite all this, But one trend that is very clear that it tends to happen more often than not, and not only that, but the performance is very robust, is that the gold to S&P 500 ratio tends to rise significantly after those, very large amounts of inversions begin to uninvert. And so we are at the process now. If you look at the gold to S&P 500 ratio, it's been going higher, but not massively yet, because the equity market has been holding up well. And, gold has been doing tremendously well. I mean, with the surge we've seen in prices is really what's been driving this ratio recently. But there's a lot more to happen here, in my view. And so I would be surprised if we don't see the gold to S&P 500 ratio be substantially higher in call it 1 to 3 years, because of this correlation it tends to have with uninversion of the yield curve. And so Treasuries is a good bet. And so in the last 20 years or so, every time you are in the position where yield curve is extremely inverted and it starts to uninvert as a recession unfolds, you want to buy Treasuries. If you are in a more inflationary era, you do not want to buy Treasuries. You're going to get in trouble. You want to actually buy gold. And so it really depends on what type of regime you're in. And now I have my opinion on that. I certainly believe we're in an inflationary era. And I think you can measure that in many ways, particularly how, commodities have been trading. We can get into that. There's kind of a rotation dynamic that we tend to see from when you're in a commodity cycle in a very inflationary era. And in my view, this gold to S&P 500 ratio may actually work even more than we've seen in the past. So I'm paying close attention to that because of this, development in the yield curve.
Essentially, gold prices are driven by investor sentiment, whereas copper prices reflect industrial demand. Against the backdrop of a soaring gold price, experts shared their outlook on where it will go next and how investors can find opportunities in the sector. As we witness a significant surge in gold and copper prices, are you considering adding more exposure to precious metals or mining stocks in your portfolio? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.